Okay, welcome everybody. So a Saturday episode today. Apologies for yesterday. I had a little bit of a mix up there, but no problem. It seems like people do like the Saturday live streams. So welcome. We've got a pretty good one today. I've actually got a little rundown here. I think people will be quite interested in this one. And, you know, fair warning ahead of time, I do feel like today, kind of feeling like I might go off on several little side rants about the financial industry. This one might actually go off the rails a little bit. So hopefully I can keep my emotions in check and we can get this all done without insulting too many people. But that is never my intention, of course. As somebody who's on the outside looking in, I can, of course, always share some of the little dirty secrets of the financial industry that they don't want to tell you. So that's the first thing we're going to be doing, talking about this impending retirement crisis. I mean, truth be told, there already is one, but with every generation going forward, it is just going to get worse. And then the second one, of course, we will talk about Bitcoin. A lot of people have been asking. As everybody knows, I do own 2 Bitcoins. So what am I going to do with it? Am I going to sell it now that it's rocketed? I don't know if this is considered to the moon for all the Bitcoin people, but it's good. You know, this is probably better than I expected when I bought those things. So people are asking a few questions. We will get to those. Of course, the open Q&A is last. Get your questions into the comment section, but let's actually start that number one, because this is a subject for me. I personally feel like every single investor in the world could benefit from seeing the data that I'm going to present people, because this is one thing that it's basically the kiss of death for the financial industry if this type of thing was readily talked about. The whole structure of everything, and dates back to what we were talking about last week, but the whole structure of those pre-packaged buy and hold style portfolios of several different assets. You buy and hold. They tell you time in the market beats timing the market. Just hold this portfolio, stay the course through the ups and downs, and you're going to be fine. Make sure you do it in a tax-sheltered account. Basically, everything the financial industry is telling people, it all blows up if you see the data that I'm going to show you. So I do believe that, let's say, for example, I somehow waved a magic wand and 1 million people were watching my live stream. I would imagine there would be a huge number of people calling their advisor Monday morning and demanding a meeting, demanding some explanations. And to be honest, a lot of people would fire their financial advisor on Monday. So let's get into it. This is essentially basically closing a loop on what we were talking about last week. I was talking about the standard buy and hold garbage that you see people pitching out there, different variations of these assets and why that's not going to work. And it doesn't really matter what variations you use, what percentages you use. It all ends up to be within about a 1% to 2% band of rate of return. And I did have a few people email, like after every live stream, I do get some response emails. And I had a couple people, I'm just paraphrasing, but essentially what they were saying was, well, what's wrong with 7% a year, right? If you can just maintain your 7% a year, you do it in a tax-sheltered account, you do that for 30 years, you know, sure, it's not a world-beating rate of return, but certainly you're going to make some pretty good progress with that, right? I mean, the financial advisors that are pitching this type of thing, which is probably 90% of them, to be honest, they're not lying to people. That's a good strategy, right? Well, let's basically analyze that. So what I started with last week, I basically started with the baseline and what I call the blindfolded monkey. Basically, the blindfolded monkey holding the Vanguard VBanks, doing absolutely nothing. The expense ratio, this is a 60% stocks, 40% bonds, balanced index fund. The expense ratio is about 0.07, so it's basically free. That's why I said, like, anybody in the world can do this. They could just dollar cost average in a tax sheltered account like an IRA, blindfolded monkey style. They could make their 8%. Now, this is during a raging bull market. So this is the absolute best it's ever going to get. Of course, when you factor in bear markets as well, you know, they do actually happen. Financial crisis before that, dot-com bust before that. This is the rate of return, 8%, not including any of that. So of course, if you stretch it out, it's going to be 7 or less. Blindfolded monkey makes 7%. So the different variations of this really garbage kind of asset style would be, first of all, adding precious metals, as we saw last week. It doesn't do anything. We went through all these examples, the HFRI hedge fund index. You'd think that hedge fund managers, well, they're the best and the brightest, right? They're the best of the bunch. They must be really good. Certainly they could beat a blindfolded monkey. Well, turns out not so much. The SVOL short volatility index. Clearly, the short vol guys, they must know what they're doing. These are hedge funds focusing on short volatility strategies. Obviously, they can beat the monkey. Well, turns out they can't. So what about Ray Dalio, the most famous portfolio in the world, arguably, the largest asset management firm, the all-weather portfolio? Clearly, he's better, right? Well, no doubt he has more money than the monkey, but the clients that follow that type of thing don't have any money. So that was essentially my point. You know, sum all of last week up in a short spiel here. But it doesn't matter what you call them. They're all garbage and they're all the same concept. It doesn't matter what variation you use of this stuff. It's all going to end up long-term when you include bull markets, bear markets. It's all going to fizzle down to about 6 or 7%. So what is the problem with that? Like this guy said that emailed me, and I had a couple of them that were saying the same thing. Well, so what, right? I'll take my 7%. I could just do this. Buy and hold the Vanguard VBanks, dollar cost average into that thing, no problem. Well, the glaring problem, of course, beyond the fact that you're going to have to pay fees to these advisors who are essentially doing nothing for you other than allocating capital, and they even have teams to onboard their clients, so they're really not doing anything. They're really spending 99% of their time marketing. But obviously the big problem is inflation, right? You have to back out inflation. Those rates of return don't include the erosion of your own money. And as you can see, it is actually getting substantially worse. I don't think the government is leaning towards more responsibility going forward. They're actually probably blowing things up even worse. So this is an even bigger problem for people. So what happens when you get somebody who's actually facing the real world consequences of fees and inflation? So let's start with a person who has $10,000. And this is extremely important to understand that this may sound good, but I think you'll be quite surprised when you see this. Most people start at the same place. We all start at zero. I'm going to give this person 10,000 just because. Let's give them a head start. And again, I'm using 7%. But typically, like I said, if you stretch this thing out for bull markets, bear markets, I would imagine you're probably looking at more like 5 or 6, especially going forward, just to the simple fact that we are starting today at all-time highs in the stock market. That is probably not a good starting point. So I don't think it's a stretch at all to say that these buy and hold portfolios starting today going forward will perform significantly worse. When you start at an all-time high, there's not a whole lot of upside. There's quite a bit of downside. So 7 is being ultra generous here. You're not going to make 7 with that financial advisor. But they're going to tell you do it in a tax sheltered account, which is always a good idea. Always invest your money as much as you can tax sheltered. But they're going to use this as some type of magical thing to tell you that your money's going to compound, it's tax deferred. This is just this incredible money growth thing. And of course, the kicker that they're going to hit you with is they'll tell you that when you retire, of course, you get taxed at the end, but you're going to be in such a low tax bracket because you're retired. The reality is, and what a lot of people find out later on, is that their tax rate in retirement isn't actually nearly as low as they thought it would be. And in many cases, it can actually be higher. So it's still worth it to do tax sheltered accounts like IRAs and stuff. Always tax defer if you can, but it's not some magic bullet. They use it as the centerpiece of their marketing campaign, but it's not that big a deal when you really factor it in. $150 monthly edition. Now, this might not sound like very much money. Where's that money coming from? So I also want to just share a little bit of information on macro stuff. For my podcast, I like people to maybe learn a few things along the way. So let's analyze where that number's coming from. So first of all, the median, this is the 50th percentile individual income in the United States, is $50,000 right now. Dead on $50,000. So this is what half of Americans make 50 grand. Then you get taxed, right? So this is the tax rate. Again, the average tax rate in the United States is about 30%, right? It's a little bit lower than the developed world, but you are going to get taxed about 30%. And then the other piece of information we need is the average American has about a 4% savings rate. So all of these things combined, you can say that this person makes $50,000. They get to keep 70% of their income. They divide that by 12 for the monthlies. And then, of course, they're only actually saving 4% of that money. So the average person is probably stuffing $116 into their investment account every month. And I'm sure you've seen all the statistics all over the place where half of Americans can't meet a $1,000 emergency fund. Half of Americans are living paycheck to paycheck. This is why the 50th median American makes 50 grand, keeps 35, and only saves 4% of that. So there's only $116 actually going into their investment account. This is a problem. But in this case, I'm going to be even more generous and do 150. Again, generous on the rate of return, no taxes, generous on the monthly additions. Again, being generous on the wage growth here. The nominal wage growth in the United States is 6%, according to the government numbers. And the official inflation rate, according to the government CPI, is 4% rolling over the last 50 years. So these are government numbers. I would be highly skeptical of those government numbers. Just for me personally, I feel like wage growth is about zero. If you do the real wage growth, which is nominal minus the inflation rate, it's probably zero. But we're going to use, Uncle Sam's fudged numbers. Every decade, it gets a little bit worse. I mean, come on, housing, food, energy. Are people really believing these numbers? But anyway, we're going to just use the full-on official government numbers. Apparently, real wage growth in the U.S. is 2%. Even though real people in the real world don't feel that, we're going to use it anyway. So this person is actually going to only have $226,000 at the end of 30 years. So realistically speaking, people who are saving that much money, people who are making that much money, they typically have about a 30-year investing time horizon, $226,000. Well, is this realistic compared to what we know about the economy? Well, turns out it kind of is. There's been a lot of studies done about this. Vanguard measures the account balances, $232,000. There's been other studies that show about $200,000. I've seen anywhere from 190-ish to about 240. So we will call it $225,000. That's what this person can expect to make at the end of it. So think about how that is going to feel for somebody. At the very beginning of this journey that they're going on, they've been encountering people tweeting and building these massive social media platforms, just telling them to buy and hold and make sure you've got some bonds to control the risk, and precious metals are good in a crisis and all these things. Add a little real estate. You need commodities. Do all these things. Time in the market beats timing the market. Just do that. You're going to be just fine. Well, what's going to happen? Well, at the end of your 30-year time horizon, hopefully it doesn't take you 30 years, but some of these people are going to start waking up and they're going to realize that, wow, I don't have nearly enough money. I thought this process was supposed to work. The guy told me 7% was supposed to lead to this good retirement if I just stay the course. And all you're really going to end up happening, instead of waiting for this to happen to you, try to put yourself in that position today. How is it going to feel knowing that you have $225,000, now you're 70 years old and you can't really work anymore, and you have to watch your asset manager, your guy that got you to this point, you have to watch him on Twitter posting about his 5-star luxury vacations to Switzerland. You have to watch him talk about how he put his kids through private school, costing hundreds of thousands of dollars. You have to watch him post pictures of his beautiful view from his penthouse New York apartment. You have to watch all these things with $200,000 in the bank, knowing that it was you that financed his lifestyle. And he told you the entire time that this was going to work out for you. All you got to do is keep your head down and stay the course. How is that going to feel? Honestly, if you have a financial advisor, and I know a lot of people in my community probably don't, but like I said, this is a message that the whole world needs to see. When you talk about 7% return, your financial advisor is not going to tell you how much of that money goes to fees, right? They're not going to tell you you're paying a percentage of your net worth every year in fees. You know, a lot of people throw shade at me, or not a lot, but some people throw shade at me because I have a subscription service. Yeah, a very low fee, flat rate subscription service. It scales 10 times better than paying a percentage of your net worth to an asset manager who's not really doing anything but tweeting, right? They're not even doing anything with your money. They're just, oh, you're a conservative investor, you might go on this pie chart. Oh, you're a little bit aggressive, maybe you're a little younger, go to that one. You'll get an extra percent. Who cares? You back out fees and inflation, you're not going to have any money left over. So bottom line is, what I would hope people do is understand that they are being herded in the it's like herding cattle, right? That rancher knows exactly what's going to happen to these cows at the end of their journey down this road that they're going. The cows don't know. They think this is great. They're looking around. They're with all their friends. They're hanging out. Everybody's doing the same thing. All the cows are happy. The rancher knows exactly what's going to happen to those cows, right? And believe me, your asset manager knows exactly how much money you're going to have in retirement. They know exactly what fate you're going to suffer. And they know exactly what their lifestyle is going to be when you realize that. So you're going to eventually wake up to this reality that we've all been lied to our whole lives about this stupid, somehow you just do nothing and it magically produces some money. Why? Why would people assume that there's free money in this world? There's no free money. If I take a bunch of assets, put them in a pile, and just watch it go, why would that make a rate of return? I didn't do anything. That would be like a lawyer telling his client, we're going to go into the courtroom, we're going to sit there, and we're not going to say a word. If they ask you a question, don't say anything. We're not going to do any legal work today. We're not going to do anything that I learned on the bar exam. We're not going to do anything about past case history, nothing. We're not going to do our job as a lawyer. We're just going to sit and stare at the judge, and this is going to work. That's what they're telling you to do. Well, I'm of the school that thinks that to be a successful asset manager and investor, you have to actually do something to beat the market. You can't just sit there and expect it to happen on its own. So, and again, fantastic for the clients or fantastic for the asset manager. They're going to be a mega millionaire for sure, and absolutely horrendous for the clients. So what could you do about it? What could you do to possibly get off this track? And I don't want this to be a pitch meeting for my own stuff. You know that I don't do that on my live streams. But the first thing that you can do is you can make a little higher rate of return. You can actually try to do something different. As I always say, in order to beat the market, you have to do something different than the market. You can't just track the market and then minus inflation, minus fees, and think you made money. Yeah, nominally you made money, but on a real basis, you've made nothing. So 12%, that is not that hard to do, to be honest. All you really have to do is be willing to be slightly more active and occasionally cycle out of risky assets and into safety when you get the signals that the market is rolling over. Nobody can call the absolute tops and bottoms of anything, but there are ways that you can look to the volatility market for metrics, and it can tell us when risk is rising, and it can certainly help us cycle out into safety. And what I always tell people is the best way to improve your rate of return is not by chasing extra gains, not by adding leverage. It's by reducing drawdowns. That is not only the easiest way to do it, but it's the most effective way as well, because losses hurt far more than the gains help you. So if you can just navigate a little bit away from the most risky periods in the market, when it's just a screaming red flag that you should not be in risky assets, you can already probably bump your rate of return up to about 12%. Give or take, right? And that's all you really need to do. Now, you have to imagine the difference. 12% isn't even double 7%. But look at the simple math. 7% minus fees, minus inflation, you're probably down to 1% alpha, right? 12% minus fees, minus inflation, you're still up 7%. So it's many multiples more than, even though it sounds like, oh, 12's only slightly less than double. No, it's not. It's many multiples more over time. So that's kind of how that works. So you can also, of course, do that. And shameless plug, the VTS community, it's less than 5 minutes a day. This is something that anybody can do. We're not day traders. We're not active in and out of everything. 2 to 3 trades per month, per strategy. Less than 5 minutes a day. It can be done. All the same metrics. This person is already going to be nearly 500,000. They didn't do anything. They invested, $150 a month. But this person's probably going to be a little closer to being comfortable. Not balling out, obviously. Don't have a private jet or yacht habit on this kind of money, but you're probably going to be much better off. You're probably going to be fine. Remember, you probably were building house equity. You can't spend that, of course. You can't eat your house. But, 500 grand plus a place to live, you might be okay. 200,000 plus a place to live, not in any city that I know. No, thank you. But the next thing that you can do, of course, is you could try to save a little bit more money. And this is why I always say I'm the type of person that Look, you'll never see me flashing lavish lifestyles. I don't do that. I don't like to pull on people's emotional strings. I am a minimalist. I believe in minimalism. I do spend a lot of money on experiences, but I don't buy flashy stuff. I don't think people should either. Stuff never really gives us any satisfaction anyway. It's really experiences with people that really gets the memories for us. So if you could save a little bit extra, $500, is that really that much? Especially since, remember, you could pair with your spouse if you have one. If you're a single guy, you can maybe start a side hustle, make a few $100 a month. $500, look at the difference that makes. Now this is a person making 12% a year and saving $500 a month. They're at $1.4 million. Now, again, we can do better than this still, but there's nobody that is going to be hurting on that much money. That's plenty, right? There's a lot of things you could do with that money. You could still invest it through retirement. It's going to be enough. Don't buy a yacht, but everything else should be fine. The next stage that you could do, maybe just save a little bit more money if people want to see this. 1,000, now all of a sudden it's 2.7 million. And again, your rate of return is not crazy here. This is a 12% rate of return. This is basically just sidestepping the, roughly 56% crash in the financial crisis. Save yourself half of that. Our VTS community suffered 0% drawdown in the pandemic. Save yourself, it went down 35, save yourself 15 or 20 of that. You don't have to catch the tops and bottoms. That's really what we're talking about here. And you can make a phenomenal difference. So 2.7 million. And then lastly, because somebody's going to email me and say, hey, you didn't include your VTS portfolio. So what happens if we actually did make a very good rate of return? Now, I'm not a hypocrite. I'm always fair on both sides of the equation. I said blindfolded monkey is not going to make 8.2% going forward. I said it's going to be closer to 7 because there will be bear markets. There will be difficult times. It has been a raging bull market, and this is the best it's going to get. So what if we also assume this is the best it's ever going to get for me? I'm fine with that. Like I said, I'm not a hypocrite. So if you want to say it's going to drop down to 18, let's even say 15, right? Can update this spreadsheet. It's going to beach ball a little bit on me. But sure, I'm fine with that. 15% rate of return. Now you're at $4.3 million. This person is going to live a very comfortable life, and it's not crazy. It's not an insane rate of return. All you have to do is just get it into your head that obviously the financial industry is set up for self-serving profit. They are not doing this out of the goodness of just helping clients. If that were the case, they would want to move towards a situation of competition. Whenever you have competition in an industry, you get the best and the brightest rising to the top. But the way that it's set up now, almost nobody shows any performance. Very few people do any work. Obviously, I'm not speaking directly to the hedge fund managers that are actually doing different and exciting things. You're exempt from my rant today. RIAs that are willing to go outside the box thinking and do some other things. Few percent of you out there, you're exempt from my rant today. I'm talking about the bulk of the industry that is set up to just no performance shown, buy and hold, stay the course, do this. It's all set up so people push money into the system and it's basically stuck there. You're unhappy with your results at JP Morgan. Well, what are you going to do? Go down the street to Morgan Stanley? You're going to go down the street to Citibank? It's all the same. It's all the same performance. You're not going to go anywhere. So that's essentially what is happening here. We, all of us, are financing their mega million-dollar lifestyles, and every year they get to go skiing in Davos and meet up together, and they know exactly where that money came from. And they know exactly what our bank balances look like, right? And will look like 30 years from now. They know all this ahead of time, right? So it's not a fair system, unfortunately. It's a very good gig if you can get it, and people have asked me these questions before. Look, you can't beat them, join them type of thing. If you want a good career, there is nothing wrong with going into that career. You're plugging into a pre-existing system that favors you above all else, and you're probably pretty guaranteed. As long as you can write articles, as long as you can make some decent videos, tweet a few times, you should be fine. It's really a marketing game. But if you are a client, you need to unplug from that as soon as possible. So there's my rant. We have to stop collectively as a society. We have to stop financing these people for not doing any work. If for some reason I could just wave a magic wand and there was one thing that I could do that would just radically change the system, if you just instituted one rule that everybody who manages capital, no matter in what capacity, you need to fund an account with real money, $25,000, and track a model portfolio that's visible on a website, public website, audited once a year. If you did that, and everybody in the world who manages capital has a model portfolio, well, now people have to get to work. They have to actually roll up their sleeves and do something, right? But right now, it's just all blind. Nobody knows. The people that you're following on Twitter, for all you know, that guy makes 5% return. One of the biggest accounts that I follow, hundreds of thousands of people follow. He has a public ETF that, I mean, it's just an absolute train wreck, and people can see it. Apparently, they can't put two and two together. I really don't understand it. But if performance mattered and people actually did work like they do in other industries, like medicine and like engineering, and the best rises to the top, the financial industry, the best marketers rise to the top, not the best investors. It doesn't favor investors. Who wants to invest? Why do that? Why not spend all of your time marketing? Who wants to actually get into the trenches and really figure out how to trade? I don't want to waste my time doing that, right? That's their mindset. And they can be mega millionaires without doing that. So yeah, no competition, big paycheck. A lot of them do it. So you don't have to participate. My tiny little channel here over at VTS, very few people are going to see this, but the people that have, you've been warned. This is why people get so pissed off at bankers, especially as they get later on in their life. This is why. It's because they're wide-eyed when they're 30 and 40 and, oh, this makes a lot of sense, right? Stock market performs the best, so of course, let's put 50% there. Bonds is going to stable things out. I could sell this stuff no problem. It sounds good, but you get to 50, 60, 70 years old, and a lot of these people get pretty jaded because they're looking at their bank account and they're thinking, this just doesn't add up. And then what have you done? Well, you've wasted 20 years of your investing time horizon. Time is the most precious asset that we have as investors. And you're going to waste 20 years bouncing around? No, that guy's 30, 40, 20, 15 is better than this person's bonds, treasuries, gold, commodities. He's doing it wrong. You got to go 30, 25 over here. You can argue for 20 years on whose cool sounding buy and hold portfolio sounds the best. They're all garbage. Every single one of them is garbage. So you can definitely unplug from that system. You don't have to follow along. All right. How many asset managers hate me today? Let's go to topic number 2. This will be better. Let's piss off the Bitcoin crowd as well. So as a lot of you know, about 18 months or so ago, I bit the bullet and I bought Bitcoin for the first time. I bought 2 Bitcoins. It was crashing down. It was actually really difficult to pull the trigger on that because it felt scary, right? This is an exercise in investing when everybody wants to call the tops and bottoms, right? It all sounds good in theory, but when you're watching something crash down, I mean, I had seen it at 69,000. And when I bought it, it was passing below 25,000, and it actually went below 20,000, right? So I was even in over a 20% drawdown when I got into this thing. It's a scary thing to do this, but I did bite the bullet. I bought 2 Bitcoins. And first of all, I'm just going to play a really short clip. It's not even 2 minutes. If anybody's wondering why I actually bought Bitcoin, even though I'm actually kind of negative on the Bitcoin space, here's why. I've said a lot of negative things about crypto and Bitcoin. So why do I own it? If I think those, and I do believe all those things, by the way, everything I said, I believe to be fundamentally true, and I would challenge anybody on any of those points. But there is actually one reason why I think Bitcoin might actually have a place as a small investment in a person's portfolio. And this is the reason that I actually bought it. As we know, the world around us is changing. It's always evolving. And social media, and certainly certain influencers on social media, have become quite the juggernauts of the world. And pretty much whatever they say and do and the directions that these influencers are going, they have enormous power to get money moving in that direction. So you've got somebody like The Rock or Kim Kardashian or, Mr. Beast on YouTube, all these people that just have insane followings. They actually can influence things a whole lot more than President Biden can, or a whole lot more than the Federal Reserve can. I mean, honestly, Kim Kardashian has more power these days than 99.9% of the wealthy politicians and all these people. They can move markets. So I look at Bitcoin, and I would only ever invest in Bitcoin specifically, not crypto in general. I think 99.9% of those coins that exist now are going to be gone eventually. But Bitcoin itself, I view as a reasonably direct investment on the power of social media. I think a little bit better than investing in the actual social media companies, like buying Twitter stock, for example. I think buying Bitcoin is a better social media play than buying Twitter or buying, Facebook or Instagram or whatever they are. That's why I did it personally. I'm kind of willing to just make that small investment. It's a very small percentage of my portfolio, and I'm not going to have laser eyes in my Twitter profile, but I am ready to hold this thing and ride this thing, and maybe not all the way, but currently right now, I'm always a person that if new information comes in, I'm willing to change. But right now, I think it's a pretty solid play on the power of social media and the fact that I do still see them pumping. And as long as they are out there pumping and convincing people that it's the next wave, it's like the internet of the 90s, all these things that people say that are clearly not true, but they're saying it with such power and authority behind it that I think it'll actually maybe push this thing forward. So 50% chance, I mean, that's plucked out of thin air, but 50-50, it goes to zero, but whatever. I mean, that's what a high risk, high reward investment is. So that's my reason I own Bitcoin. There's 5 terrible reasons to own it, but that last one is actually the reason why I own it. Okay, so that was just a little clip I made because so many people, I'm actually pretty negative on the entire crypto space. And a lot of people are wondering, well, if you're so negative on it, why do you own a couple of Bitcoins? Well, that's essentially why. It's just a small allocation, high risk, high reward kind of thing. But essentially, just to keep everybody up to speed, if you're new to my live streams, why am I negative on crypto? Well, I'm not necessarily negative on Bitcoin in the short to medium term. I think it's fine, right? That's why I bought it. I figured it was a very high probability it would go up. I'd make some money. And even in the medium term, I'm fine with crypto for at least a couple of years. But here's my prediction, and you can come back in 5 years and see if I was right or wrong. But here, my prediction is that eventually the Federal Reserve, the government, the US government, they're going to get into this game. And when they do, what do we know about governments? Of course, the one thing that we know is they do actually like to control their money supply. They do actually like to know where all the money is, and they especially do like to collect tax dollars. So they're not actually just going to sit idly by and watch this new industry just take over and have all these people unplugging and disconnecting from the US government's money supply. So what's essentially going to happen is they're going to come in, there are going to be massive regulations, they're going to basically have laws against hiding your money through crypto and all that stuff. And I understand there's going to be some rogue people and some real standouts that fight the system and stick it to the man right to the end. There's always going to be a percentage of those people. But what you're going to notice, and this is my prediction, is that once the Fed coin kind of comes into play, there's a few ways that they can get people to come on board. They'll probably figure out some silly reason to do a stimmy check of some kind, maybe some type of, I don't know, climate change stimmy check of some sort. Plug into the system. We'll give you $800 if you sign up, something like that. And once they outlaw it and make it illegal, you're going to find that most people are not going to go against the US government. So it's just not going to have the steam to go to where a lot of these people think it's going to go because, this is the US government we're talking about. It's one of those paradoxes or this, people don't really put 2 and 2 together when they say these things. But on the one hand, they will say that the US government is the most powerful, draconian, overarching, they're going to stick it to us every chance they get. They're killing their money supply. They're doing all these things. It's basically, the big bad corporation. Oh, but on the other hand, all we have to do is just go over here and unplug from the whole thing. No. If you believe that the government is what it is, then surely you think they're also going to stamp out any opposition to it. I think that's pretty obvious. So come back in 5 years and let me know if I was right or wrong. But let's get into what I'm doing with my Bitcoin. So essentially what I'm going to do is I am going to start, this isn't active trading. I'm not calling myself a Bitcoin trader. Don't worry. I am not sophisticated in this game at all. But what I'm essentially going to do, I have 2. I'm going to sell one, maybe tomorrow. Like there's no reason to keep holding it. What was it up? 62,000. It might go to 100,000. Who knows? Nobody knows. Anybody who says they know, they don't know. Nobody knows anything. So 62 is fine. I might sell it, and I bought it for 24,400. So made a pretty nice little profit. I'm going to sell one of the Bitcoins and keep one of the Bitcoins. And I'm going to do a little head-to-head battle between my one Bitcoin that I will buy and hold, and I will laser eyes this and ride it right off the cliff, or diamond hands, or whatever it is. I'm old. I'm almost 50. Forgive me. Whatever the lingo is, I'm willing to hold this thing. And then I'm going to trade one Bitcoin, and it's always going to be one full Bitcoin. Well, I don't know. If it goes to 1 million, I might have to change my tune. But then I would have this one. So yeah, tentatively speaking, it'll be one full Bitcoin. And I'm just going to see if my active trading, if there's any way to try to find some signals to perhaps actively trade a Bitcoin and outperform a buy and hold Bitcoin. And I'm hoping that there is. Obviously can't call tops and bottoms. So what I'm predicting ahead of time is whenever I sell this Bitcoin, I'm going to be in a drawdown compared to the buy and hold, right? Because I probably didn't call the absolute top. And then when it's crashing down and I'm ready to buy, I'm also going to bleed a little bit of capital there because I wouldn't have caught the absolute low either, right? So it's going to be an uncomfortable drawdown. It's going to feel like the world is ending as far as Bitcoin goes. And then hopefully I can buy and sell this Bitcoin, and I'll publish it. I'll post it like I did last time on Twitter, and I'll talk about it in my live streams. But I think it'll be kind of cool to see if there's any way to do that, because it seems to me like if you were to imagine a waveform of Bitcoin prices, and I know it's not totally equal, but just imagine it. You can't call the tops and the bottoms, but what you're essentially trying to do is cut off some of the top where you sell and cut off some of the bottom where you buy back. And that little edge over time should balance out. It's like real estate. Nobody can call the tops and bottoms of a real estate market. But if you just buy when it's reasonably cheap and you just sell when you feel like it's reasonably expensive, it doesn't have to be peak cheap or peak expensive, just expensive, cheap, buy, sell. Over time, over a long period of time, you should be gaining a little bit of an edge by doing that, right? As opposed to buy and hold. Sure, you're subject to all the gains, but it's exactly the problem with the stock market and every other asset class in the world. Yeah, you're subject to the gains during good times, but don't forget, this is coming again. There's going to be another financial crisis. The dot-com bust and the 2008 crisis was not the last one. There's going to be something. I mean, recovering from the pandemic cost, what, $7 trillion? They're not going to be able to do that again next time. So this is coming. That's the problem with buy and hold. There's nothing wrong with the stock market during good times. There's a lot wrong with the stock market long term, because long-term, the rate of return is less than 10%. It's the same as treasuries. There are periods where treasuries fine, but there are also periods where it's a disaster. Gold, nothing wrong with this in good times. I'd hitch a ride on that. But then it did 10 years and it didn't do a thing, right? Real estate, same thing. Huge, glaring problem. But there are periods where you'd want to own it. Commodities, the same thing. This is the problem. So my theory is that if you just kind of buy things when they're relatively cheap and sell things when they're relatively expensive. It's like a lot of my option strategies are essentially based on this topic, right? If you assume that the options market is reasonably efficient, and I think that it is, from a retail perspective, there's really no arbitrage that we can get, so it's reasonably efficient. All you really have to do is buy volatility when it's reasonably cheap and sell volatility when it's reasonably expensive. Rinse, repeat. Long term, you should succeed. Now, obviously in options, you want to ramp up your trade frequency as well. You want to do 5 or 6 different strategies with a lot of trade frequency in each, very small allocations. And when you churn it like that, law of large numbers, of course, long term, you're going to make a really good rate of return. Bitcoin, I only have one, right? So my buy and my hold and my sell periods might be stretched out a little bit, but let's go. So if people want to kind of follow along, you don't have to buy one Bitcoin. I mean, obviously over time that might scale to a pretty large amount of money. And even I allowed myself a little backdoor caveat there. If this thing actually does moon like everybody thinks it will, I'm not going to be dropping $1 million on my next Bitcoin. So yeah, but if you want to follow along, if you want to share strategies, who knows? Because of these ETFs and whatnot, there might actually be, at least for as long until the government squashes this whole thing, which is coming, by the way, there might actually be some signals that we could use for timing, right? It's never going to be as robust as the volatility market. That's based on massive, equities, S&P 500, VIX futures, all this stuff. But, who knows? Maybe the crypto market will give us a few signals to play with. So that'll be fun. I will fill everybody in on how I'm doing. So far, yeah, I think as of now, tentatively, I'm going to sell. So I'll sell one of the Bitcoins, and I made a little bit of money. It was cool, but long term, I'm still bearish. And like I said, in that little clip, I'm a quant-based investor, always evidence-based. I basically reserve the right to change my mind if something changes. That's what wise people do. So if something in the Bitcoin market radically changes, if the government changes and actually gives the appearance that, no, we're fine with this, we're going to let Bitcoin go, and then the market changes. But as of now, I think that just what we know about the U.S. government, they're not going to allow a loss of control to their money supply. They just aren't. So can't have it both ways. They're either big bad government or they're just a little kitty cat. But you can't have both worlds there. I tend to lean towards the draconian, overreaching government. So I'm actually kind of worried at the power that they actually do have. All right, let's get into some questions. So in India, we don't have any volatility products. Sorry to hear that. We only have index and stock options. Any advice on how to build a portfolio like yours? Well, sure. So what you want to do, and I know you, so I know you have access to this, you can go into our course library at VTS, and there's several courses up there already. You can go to the one that's about stock replacement, and this is essentially what you're doing. You mentioned that you have access to stock and index options and whatnot. All you really need is access to US-based ETFs and the options market, which you should have. This is also a problem that comes up a lot with Europeans who are struggling with those MiFID II regulations. Can't, for some reason, hold US-based ETFs because apparently they're protecting your investments. I don't understand it. It's definitely more risky when you limit people's choices, right? I like to be my own risk manager. I don't want other people telling me what I can and can't do. But anyway, if you have access to US options markets, which you probably do, then all you do is whenever we're doing volatility instruments, you are going to be either buying put options or call options on the VXX itself, deep in the money. And I do give signals in the VTS emails. So our tactical volatility strategy, if you look down here, here's the stock replacement course. You can go through that. But also, I give the trade instructions. So we've been allocated a short vol for quite some time. And this SVXY position can be mimicked by buying this deep in the money VXX put option, right? This is a roughly 0.55 delta put option. So it's actually mimicking the 0.05 inverse volatility ETF. This SVXY ETF and this option actually move with the same strength. So if you were to allocate capital to both of these, and I actually did a full video on the YouTube channel proving that over a 3-month period, that they end up at the same spot. You can actually just take the stock replacement instructions down here. Now, you could also do it with the others, defensive rotation. The Qs are highly liquid. Don't use the QLD for options. Use the QQQ. XLU is highly liquid. You can definitely do that. And then, of course, the SPY, there is absolutely no issue with the SPY at all. So what you're essentially trying to do is stock replacement. Couldn't be easier. There's a full course there. And I will, at some point soon, I think, do a full live stream. I'm just going to open up the trading software, pick 3 examples, Qs, SVXY, maybe the SPY or XLU or something, and show people how to do it. It's actually a lot easier than you think. So that's what the course is for. You can do this, trust me. It's just, now, one little caveat, one little warning here. Options trading, if you're doing stock replacement, is actually highly dependent on the price of the ETF itself. So when you're talking about VXX, most of the time, unless something real crazy happens, most of the time it's in the teens, 20s, maybe if it gets high, 30s, and sometimes it dips below 10 before it does a reverse split. So it's actually very easy and cost effective to do that. Now, if you're dealing with something like the SPY that's at 500, obviously one contract is going to be quite costly. So stock replacement on a very large account gets more problematic. The efficiency starts to scale away. You can imagine that if you're doing VXX and you're buying 20 contracts, the difference between 20 and 21 is almost nothing, right? It's negligible. But if you're doing the SPY and you can only buy one contract, the efficiency difference between one contract and two contracts is massive, right? So you're going to notice some real inefficiencies. So there's going to be 2 more lessons added to that course soon when I get some time, talking about risk reversals. It moves a little bit different, but it essentially involves selling an option and buying an option, and it mimics a stock as well. I prefer stock replacement with deep in the money options, but risk reversals do it, and a little bit different margin requirements there, but it should be better for a large account. So those are going to be coming soon. Stock replacement, that's your answer. Easy, easy. All right, would you discuss using VIX minus volley in relation to options trading, ETFs, indexes, equities? VIX minus volley. So this is one of our metrics. I mention it. We don't really talk about it much because it is option market specific, but I will show the numbers, show where we're at basically. So this is more of a conceptual thing. When you think about options, I mentioned before, what you're essentially trying to do is sell something that's a little bit more expensive or a little bit, in its higher range, and buy things that are a little bit cheaper. And when you find that little small edge and you churn it over time, that's where the edge comes. You're never going to do anything in options that just, you do one thing and it just radically changes everything. It's basically 6 or 7 small edges added together, and efficiency is one of them. So the VIX index is tracking the S&P 500 options market, strip of all options. So it's basically the volatility index. The volley is tracking only at the money options on the SPY. So S&P is on the SPX options full strip. Volley is just at the money on the SPY. So when you do like you said, the VIX minus volley, what you're essentially doing is you're isolating where that premium is. Now, in of itself, this is not overly useful for, say, ETF trading or stock trading. But if you think about how useful that could be for an option trader, some option structures are very similar. They just sell different ranges. So a short straddle is selling at the money options. A short strangle is selling out of the money options. The risk reward profile of a short straddle and a short strangle is basically the same. A short iron condor is basically the same thing as a butterfly, an iron butterfly. The risk reward profile is the same, but they're selling different strikes at different strength. So if you look at the VIX minus volley, you can basically choose the best option structure given the current market. And that little edge, if you exploit it over and over again, it actually could lead to a significant difference long term. So if the difference between the VIX minus volley is really wide, right, then maybe you want to be selling the straddles. And if it's the opposite, then you can sell the strangles or the iron condors because you're selling the wider wings. Or if it's narrow, you can do the iron butterfly. It's basically helping you with the option selection is what's going on there. It's one of those metrics that I look at with every option trade. And it would be the same thing as, say, the wheel of fun strategy. Should you sell at the money? Should you sell out of the money? There's these little edges that you can start exploiting in options trading. And that's what my metrics in the email are for. Some of these are actually game changers. I was going to say none of them are game changers, but a couple of them really can radically improve. Like the VIX oscillator, of course, that's going to be that by itself is going to get people that 12% return that I was talking about. I mean, that's no problem. There are some of those metrics that are really, really good. But some of the other ones, they're just little edges here and there, and that's one of them. So I would say get used to using that, get used to looking at that. You might choose some slightly more efficient options, and that's what it's all about. Okay, this is interesting. You're inspired by my discipline and hard work. Thank you. I always found it difficult to stick to my goals and habits. Okay, don't we all? For some reason, I can't stay committed for long. How do I build mental strength? Okay, so I like off-topic questions, but I don't want to say anything that might be construed as insulting. I don't want to do that. So when I see people say stuff like this, again, I have to be real careful how I dance around this. I'm not saying this to be I don't want this to sound insulting, but essentially what's happening when you are having difficulty sticking to your goals is that is your brain telling you that you've not prioritized that goal. That's what that means, right? If it was a priority and you really did truly value it, it would be much easier to stick to it, right? A side, totally side thing, but this is often what happens with people with weight loss, for example. Everybody in the world says that they want to get healthy and lose weight and exercise and all these things, but what's really happening is they do prioritize the, really junk food and sitting on the couch watching football with a bag of Doritos. They value that more than going to the gym. So it's really just a priority problem. It's what's going on. So what I would suggest that you do, instead of beating yourself up and instead of self-deprecating yourself and saying there's something wrong with me that I can't stick to my goals and I see all these other people, they're doing these things and they seem to be able to follow through, and what's wrong with me? There's nothing wrong with you. What I would say is instead of beating yourself down, you want to build up that goal in your head. You want to make a list of all the reasons why that is an admirable goal to chase and all the rewards that it's going to get you on the other side. And once you build that goal up to a point where your brain truly recognizes that this is worthwhile, then you're going to find all kinds of discipline. You're going to put in the late nights. You're going to bounce out of bed in the morning and get right to it. And it actually gets a lot easier. So, with the whole weight loss thing, I don't know if this is appropriate to say on a live stream, but 99% of my audience are men, so they might relate. But if you were to ask the men, like certain men stay in really good shape, right? So if you were to ask men, why are you able to stay in good shape? Surely if they're giving a public answer with the PC answer, they'll say, well, I feel great and I do all these things and it makes me proud of myself and all those things. But there is also the aspect that perhaps they just want to date higher caliber of women, and that is one of the things that gets you in the door to doing that. So they have built up this reward in their head to the point where they probably don't like working out any more than any of the rest of us do, but they've just prioritized like, well, I like this is worth it to me, and it's this big shining goal that I can get, and so the work becomes a lot easier that way. Same thing with building businesses. Nobody likes to do the work, but if you build it up in your head, all the things that you're going to be able to do when you achieve this goal, and you're going to have all this extra money, and your spouse is going to be able to, get dream vacations, and everybody's going to respect you more, and all the things that you wanted to buy, hopefully you're not into things, but all the stuff you wanted in your life, it's going to be achievable. Well, just trick your brain into thinking it's top priority. That's what's happening, I think, is that you can do one of two things. You can either build the goals up in your head, or you can just choose better goals that make you more proud, right? That are actually aligned with what you want to do. For me personally, there are certain things that I do that other people might think are requiring discipline, but if I actually like to do them, then is that discipline? Really, at the end of the day, is being very efficient doing something you love actually called discipline? No, not really, right? Because my brain prioritizes it and it's easy. So you can do that. You can either choose very specifically different goals and get off this train, or if it's something you do need to do, then make a list, tell yourself specifically all the rewards that are going to come and chase it. And your brain will get the dopamine hits to chase that goal if it's worthwhile, right? That's what I would say. Yeah, hopefully that didn't come off too... You never want to berate yourself over like, what's wrong with me? You want to build up the other side. It's positive reinforcement. Okay, great channel, congrats. First time here, awesome. Thank you for showing up and asking a question. I noticed the October VIX future is looking quite unusually elevated. Any views on what is behind it? The election. Looks like an interesting trading opportunity. So what you're essentially talking about is the VIX. Hopefully I don't get this spam blocker thing that always pops up. We're talking about the VIX futures term structure, and this is the October future. So this is not really tradable, because the way that the VIX futures work is everything is rolling, and it's basically a constant rebalancing situation. So it's not really tradable. If you wanted to isolate them, like I get a lot of people emailing, like, what about some type of calendar directly on the futures? You could do that, but you got to remember that there is some risk on the other side of that. I personally don't trade binary events. I never do. There's a video on my YouTube channel called the double uncertainty principle. And essentially I was talking about the fact that you should never trade a binary event because you don't know the outcome. That is obvious. We don't know the outcome of the binary event. But the double uncertainty, the second uncertainty, is that we don't know, even if we had perfect clairvoyance on what is actually going to happen, we still don't know how the market's going to react to that news. So as an example, the election, that's why there's that massive kink. There's a lot of uncertainty around the election. So if Biden wins, let's say I knew ahead of time Trump's going to win. All right, I happen to think Trump's going to win. So let's say Trump wins. Let's say I had a time machine. I knew Trump was going to win. I still don't know how the market's going to react to Trump winning, right? So you might think, oh, I called it perfectly. I nailed it. Well, what did you nail? The market could easily sell off at that point too. Remember the last election with Trump and Clinton, there was that interesting nighttime session where everybody was saying if Trump gets elected, the market's going to crash. And initially it did, right? I remember it went limit down early on, but then skyrocketed for 3 straight months. That's the double uncertainty principle. Nobody knew who was going to win that election, and nobody knew that the person that does win the election, how do you know which direction it's going to go? It's the same as earnings. You don't know if it's going to be a good or a bad earnings report. But even if you do call it correctly, you still don't know if the market's going to dump on a good earnings report or skyrocket on a good earnings report. They both happen. Or sell off on a good one. That happens too. So I would say that as far as volatility ETFs, there's no edge there because this is just a rolling futures market. That'll all fix itself anyway. It's a balance of the VX30 basically. So when the time comes and those products are actually using those futures, it's just going to be as smooth as could be, right? I'll even do a live stream at that time. You'll see that assuming the market is fairly normal, you're not going to see any craziness in the VXX, the UVXY. They're all going to trade perfectly as expected. As far as specifically targeting the future for some type of, calendar way out in advance, you can go for it if you want, but I just don't see that as an edge personally. Okay, where am I? Sorry, another unrelated question. You can always ask questions. We're less than an hour still. I'm a photographer, and social media is the only way to get clients and have my work known, but it also makes me less focused and unproductive. Any suggestion? I just tweeted about this recently. I said basically, if you are a person who doesn't need to use social media for making money or getting your brand noticed, get off social media. Just go live your life. It'll be fine. You're not missing anything. This is melting our brains. It's turning us all into marshmallows. This is terrible, right? Social media is killing society. So if you can exit and live a wonderful life, and you will not regret it, right? There is a 0% chance that when you're 75 years old, you're going to look back and say, I wish I knew what was happening on Twitter when 30 years ago. This is never going to come up. You're not going to regret it at all. In your case, this is your job. In my case, if I want people to show up to a live stream, unfortunately, I have to be on social media. So I'm in the same boat as you are. I have to deal with this plague on society just like you do. So best ways to do it, I would say number one, this is specific to me. There's no reason in the world that I need to scroll social media on my phone. This is my office. I'm in my office right now. I'm on my computer. If I'm on social media, it better be right here, right? That's rule number one, is that it has to be in an environment that I control. So I don't do the apps on my phone. It's basically a skeleton. I have a plan here in Dubai. I don't have any data package. I just have like 30 minutes of phone calls and, 20 text messages or something. I don't use phones very often, and no data for streaming or watching videos. Everything is done here in my office. So for you, I would say, I don't know. I don't know where you can minimize your exposure, but you have to identify your weak periods and just avoid them as much as you can. If you know that if you pick up your phone and start scrolling and you look back an hour and a half later and where did the time go, well, then you got to stop picking up your phone. That's just the bottom line. Again, it requires discipline, but it's a disaster. It really is. It's a tough problem. I would say you want to curate your following very specifically, and as soon as you get the hint that there's anybody on that feed that's not offering direct value, get rid of them. That's it. For some reason, our silly little human brains, we hate watch. We follow and we read stuff from people that we really, not only we don't care about, we actually don't like, which is just crazy to me. And I've been victim of it from time to time as well, but you have to catch yourself doing that and just stop doing it. Just because somebody is on there doesn't mean you have to listen to them. Just get rid of all the low quality content out of your life. You will not regret it. I would imagine in photography, there's got to be a thriving community of positive people sharing their work, and you don't need to get dragged into the trenches with any of that. And of course, politics is totally silly. None of us can control any of that stuff. So just live your life. I don't know. I can't offer a whole lot. I hate social media and I'm barely on it, so I don't have that problem. But I can see it's eating away at society. So I answered this one already. Cool. I'm concerned that short volatility products have temporarily lost their allure as they seem to be stagnant. Stagnant, not to mention their underperformance compared to the market. Which market? So where does my, let me just quickly check if this is the actual article. Oh, it's not. I did an article recently for our community talking about how we entered the majority of our positions, well, all of our positions, on November 1st, basically. I think one of them was on November 2nd, but right at the beginning of November. So that's 2 times the QLD, the NASDAQ. That's SVXY, which is minus 0.5 inverse short volatility, and then the SPY, right? We entered all 3 of these positions 4 months ago, and we've just rode this trend, right? It's uncomfortable. I feel like, wow, the market's overvalued. Should we get off? But I always go by the numbers. I always go by my metrics and systematic trading. So I've managed to stay in this trend and just collect the profit the entire time. But if you want to compare them, I think the QLD, just off memory, because it's 2 times the NASDAQ, so the defensive rotation is up 50% in the last 4 months. Call it, what, November to the end of February? Yeah, 4 months. That's up 50. The SPY was up, what is it, 18, 19? I'm going by memory of like an article on Wednesday or Thursday. And then the SVXY was in the mid-20s. It was like 24% or something. So the SVXY, oh, I can show you this one part. I can show you that it has a beta factor more than the S&P 500. So remember what beta is beta measures how much one security moves in relation to another security. So what we do every day for the portfolio is I show everybody our actual beta exposure to the market by measuring the beta of all of our individual positions, apologies for the scrolling, the 4 strategies, and the beta that they display long term. So right now you can see the QLD, because this is 2 times the NASDAQ. On average, this isn't day to day, it varies, but on average, if the SPY goes up 1%, the QLD goes up 2.28%. If the SPY goes up 1%, the SVXY goes up 1.36%. So even though this is a 0.5 leveraged product, it is more exposed to the stock market and moves faster. Now, obviously, that is both directions. So this is, again, why you have to cycle out of aggressive positions and into safety, because we're holding leveraged positions. It's fantastic when we're making 50% return, but we need to exit out into utilities and to cash before the NASDAQ suffers an 80% drawdown again, right? So your question, I don't want to say, oh, you're wrong, but I'm wondering what securities you're measuring against, because the short vol trade is alive and well. Trust me. It's, the tactical volatility strategy from from 2022, January 2022 until today would be up 110%. I think it's doing just fine, right? So the strategic tail risk is only up, well, not only, but it's up 20% in 2023 plus 18 this year. It's probably up about 40%, whereas the other one's up, 110 or something like that. So short vol is definitely working very well. And I am curious maybe you're getting swayed a little bit because we do use the 2 times NASDAQ, and that's doing way better than the short vol trade for us. But yeah, NASDAQ's rocketing higher and we use 2 times leverage, so sure. Compared to that, the beta, is well over 2 for the 2 times NASDAQ. But overall, no, the short vol market is robust and healthy, and it's decaying as it always does. We just have to sidestep those big spikes. As always, shorting volatility is pretty easy 80% of the time. It's make or break is what you do with that 20% where the market doesn't cooperate. That's where you make or lose all your money. So we're hanging in there until we have to exit to safety, and we will be exiting as quick as possible when the risk elevates, because you do not want to be shorting vol when the market goes the other way. Okay. A limited supply of nothing can be a valuable investment. Bitcoin, you mean? If you get in at the right time and get out, it's going to zero in the long run. I agree with this. Well, I don't agree with the first part, but I agree with that. That was my rationale, that I personally believe there is a strong ceiling on the Bitcoin market simply because the government is not going to allow a loss of control of their own money supply. They're just not. So the question is, how much can we make in the meantime? And I think even if I was holding Bitcoin and it went to zero, I'm hoping that I've made enough money and banked enough money that tradable one coin has made me a profit. So all I really have to do, I can go back to the screenshot. If I sold today, I would sell out for 62,000. I bought this one for 24,400. So I'm up 37,500 on this coin, and I'm up, of course, the same on the other coin. Let's say that I held this buy and hold. It went to 500,000 and then it went to zero. And I buy and hold diamond-handed the whole time, and I lost all my money. I thought I was going to buy Lamborghinis, one color for every day of the week, and it turns out no, it went to zero. Well, I would have already I haven't sold this yet, so I'm not going to say I have, but I will sell it soon. I will have already made 37,000 profit. So technically, I'm basically over my cost basis as long as I get out of this position now. And then it's just a race for me, a race against the Fed coin. When the U.S. government finally decides to crack down, I'm hoping that I've banked enough profit that this coin is completely free, and maybe I had some time to do something with that one as well. So that's the rationale behind it. But anybody who's literally going to diamond hands their investment in Bitcoin, I would implore you to really think about what could happen, right? Even if you think every time you're negative against Bitcoin, I mean, you get hate like you wouldn't believe, right? Maybe you've experienced that. If you don't say anything but the best things in the world about this thing, an army of people are going to be attacking me. But the truth is, the vast majority of those people that are attacking me don't own even one Bitcoin, right? How many people own one whole Bitcoin? What is it? 50 million people own some Bitcoin, and only 2%, something like 2% own 0.1% of Bitcoin, something like that. I've seen this crazy statistic. So it's really not that many people that own one Bitcoin. There's people that own like hundreds or thousands, and then there's just millions of people who have 0.1 or 0.2, something like that. So, as far as skin in the game, I did go with 2, so don't come at me too hard in my comment section. I do have skin in the game, and I'm allowed to be negative on an investment that I own. It's the same thing as my tactical volatility strategy I just said. We're up a crazy amount, but I think the market's gonna go down soon. It has to, right? So what is wrong with being rational ahead of time, knowing that when the time comes and I get the rational signal to exit, you don't want to make that mistake. You want to be fluid and liquid and be able to change. So I would just implore these people to don't ride it completely off the cliff. It is not unreasonable to think the U.S. government could put a serious halt to this. Not everybody. Your favorite YouTuber will still fight the good fight, but the vast majority of regular citizens are not going to willingly break the law. They're just not. So don't think that you're part of some big brotherhood and you have to hold it to the very end. Your goal is to make money, and I want you to make money. So hold your Bitcoin, trade your Bitcoin, all your cryptos, do what you got to do, make your money, but just know that at some point, if it gets too big, the government's going to want their piece of it as well. They're going to want their coin to be the one that everybody uses. So, and I suspect they're kind of letting this happen. Like, this is incredibly good data for the U.S. government and the Federal Reserve. They're probably collecting all kinds of data right now. How many transactions, how many people are interested, all the social media hits, what are the interactions, what are people saying about it, how willing are they to make transactions at a store. They're gathering all this free data and they're letting this guinea pig, Bitcoin, do all the data collection for them. And then when they bide their time and they have their plan and they meet in Davos, the WEF forum, in these secret locations, and they're all drinking their scotch and their cigars, and they say, okay, now's the time. Most people are not going to fight against those people. You know, we're going to lose. The general population, I'm not breaking the law to fight the U.S. government. If they say it's illegal, I have to pay my taxes, and the only crypto I can do that in is Bitcoin, well, or is Fedcoin, then guess what? I'm not breaking the law for you guys. We're not in a brotherhood. Make your money. I want you to make as much as you can, but don't make a huge mistake. So we'll see how high it goes. I'm betting on the actively traded Bitcoin. I don't know. We'll see. It's kind of fun. If I had a long enough time horizon, I would say it's 100% certainty that I could actively trade one better than a buy and hold. But I don't know how long we have before. I feel like we've got a year or two. And I feel like if Bitcoin goes over 100, I would imagine that'll accelerate their plans. It's really about market cap. They just don't want too many people to warm up to the idea that you don't want to use US dollars. That would be a huge problem for the government. They don't play nice with competitors, let's put it that way. How can you ensure you don't suffer a 60% drawdown in one day with SVXY? Well, you can't. So this is why I always say that going long the inverse products, just factually speaking, is always safer than going short the ETFs. Because if there was some type of cyber attack, if there was some type of massive event, a flash crash, some type of geopolitical turmoil that rocks the world, it is certainly possible and plausible, to be honest. That's probably going to happen at some point. I don't know. The world I live in looks pretty grim, and the more technology gets, out of control. I think technology is outpacing our morality and ethics, and I think that at some point we're going to see something, some major cyber attack or something. So it would be wise to think that something like that is maybe on the horizon at some point in the next, 20 years. We invest for decades, not years. So we're going to be in this game for 20 years. We better make sure that we can minimize the losses. So you're always better off doing the long inverse ones because you can only lose 100%. And the 0.5 leverage factor is an advantage because it takes an awful lot to move that thing that much. You got to remember that the only reason, I know people are going to be like, oh, what about Volpocalypse? The old SVXY crashed 96%. That is true. But the old SVXY was 1 times leverage, first of all. And secondly, that was a problem in the liquidity of the VIX futures market. That was not an actual organic move of 96% for the SVXY. It was actually, if it tracked the VIX futures correctly, the 1 times XIV and the 1 times SVXY would have gone down about 35% that day. That's what the actual market moved. From 35 to 96 was just the liquidity crunch in the volatility market. The end of day rebalancing couldn't keep up with everything. And it was a total disaster in the last, 15 minutes in the aftermarket. That's what happened. But you have to remember that A, the volatility space is way smaller now than it used to be. So back then, the volatility ETPs cumulatively had a larger market cap than the VIX futures that they are trading off of. This is obviously going to be a problem if there's a one-day spike. But right now, that threshold is skewed way to the other way. The VIX futures can handle plenty of volume right now. Might change in the future, and I will let people know when it does. But right now, it's much safer. The second thing is the introduction of SVIX and UVIX. They actually use different systems as well. So they don't do a really narrow end-of-day rebalancing. They can stretch that out into a 30-minute window, and they can also use a different secondary market to trade. There's a lot of things that they did to improve the volatility space since Volapocalypse. So A, SVXY only went down 36%, and it was 1 times, so half of that would be 18, and the VIX futures market is robust enough to handle it now. So as of now, totally fine, totally fine. To be continued. Like, I don't know. In the future, things will change. Like I said, I'm evidence-based, and if that changes, follow me on Twitter, follow my live streams. I'll be the first one to inform everybody that the risk is rising, and if something terrible were to happen, now would not be a good time to be holding this and these 3 products. Shift over to these ones. Maybe we'd shift over to the ZIVB, for example, possibly. But right now, totally, it's fine. The second thing is, just really, really quickly, crashes don't tend to happen during those low ranges. So we've got one little small insulation from the fact that we have a pretty large safety range, to be honest. This is about a 63% threshold, but almost all the time, those types of spikes happen on day 2 or 3 or cumulatively after several days. Again, Volapocalypse is a terrible example. That is not an organic event that happened. That was a one-off. It was scary. We didn't lose any money. I cycled out a week before. We were in full safety. We just watched the whole thing go down. But we're not there. We're fine. This is an interesting one. I'm kind of going to punt on this one because I think I'll do a standalone video. There's a lot of people who just wildly misunderstand what SVOL is. I don't know why it's popular, to be honest. And I don't want to badmouth the asset managers who manage it. I'm sure they think it's adding value. It's certainly getting assets under management. But I think if people saw what it really is, like essentially SVOL, I wonder if I should completely punt and just shut up or say one thing. SVOL is essentially a very, very watered down volatility product. So it's like 0.3%, 0.3 we'll call it, inverse. So on the one hand, it's 0.3. And then they've also got hedging, which I said earlier, I want to be my own risk manager. I don't want somebody else managing the risk. I don't know the parameters they're using for those hedges. Hedges themselves burn capital, and they're very rarely pay off. So the problem with hedges is that by the time you burn so much capital that by the time you actually need the hedge, you've spent more money hedging all of those times than you actually saved yourself just suffering the drawdown in the first place. So I don't know what their hedging is. I don't want to trust somebody else to hedge. I know how to hedge my own portfolio and my own strategy. So, and then the other issue is it pays out dividends. And of course, as we know, if you follow on Twitter, there's just millions of people who just radically underestimate and just flat out don't know what a dividend is. They actually think that somehow a dividend is like free money coming into your account and you're compounding at an incredible rate and all you have to do is hold them. They don't realize the dividend comes directly out of the stock price. Like you're not getting anything. It's just the day the dividend is paid out, basically the value of the company goes down that much. You didn't get anything. So plus you have to pay taxes on that distribution. So it's really, there's a crazy amount of misinformation around stuff like this. You will certainly see people on Twitter saying buy and hold SVOL. Do not listen to these people. Anybody who says you should buy and hold a volatility ETF, they just do not know what they're talking about. Okay, in the leveraged defensive rotation video you posted last week, you stopped the performance chart in January 2022 before the 50% drawdown. Why did you do that? That is because that video was made 2 years ago. That's just a repost of, I don't think it's quite 2 years, but let's check. As I've mentioned, I am, You can see who I'm basically following. I love Chris Williamson. Where is my YouTube channel? You can see what I'm actually doing with the course. Hopefully you can see this, where I started with the first lesson, which is the total portfolio solution. And then I posted this video second. I think I even have the course pulled up somewhere here, don't I? No, I don't. The total portfolio solution course is basically going in a structured order. So just to give you a heads up, this video was made like 3 weeks ago. This video was made 2 weeks ago. This video was made, I'm going to say 18 months ago, something like that. And the next video, Strategic Tail Risk, was also made 18 months ago. And then the Iron Condor video, where is that at? This is going to be deleted and put here next to the Strategic Tail Risk. And this one was made a year ago. So essentially that's what's happening is as you know, I am trying to build the VIX options course. And I thought I want to reintroduce the 5 portfolio strategies in order in the course, lesson 1 to lesson 5. And I don't want to reshoot videos and re-edit because I'm spending my time doing other things. I could have done that, but who cares, right? It's the same strategy. And as you pointed out, sure, we had it wasn't a 50, it was a 40.22% drawdown, but we are up 83% in 2023 and 50% just in the last, so what are we up this year? 17? We're up 105% since that video was made. So if you want me to reshoot the video, re-edit the video, spend 10 hours doing that just to show you that my strategy is way ahead of where it was when that video was made, I suppose I could do that. I know you, and you do come around trying to poke at stuff, and it's just every time you're just whiffing at air. You're batting 100 when it comes to saying things that you should probably know the answer to, since you are one of these people that have very little going on in your life and you hate watch. So I can't help you, sir. I can just tell you that everything I do is on the up and up, and it is ethical. And if you ask me a question, I will highlight it and I will give you the answer. And the answer is we're up over 100% since that video was made. I'm not hiding a damn thing. So there you go. There's your answer. You can come back next week and ask another dumbass question if you'd like. And if you think I'm being aggressive, you should see how many comments this guy, DMs, emails, like just nauseatingly stupid. But okay, come back. I'm not going to block you. It's a public live stream. You can send your typical 6 emails to me anytime you want. I'll be expecting them on Monday. All right. It's just these people, I just don't know what they're doing with their lives. If you don't like somebody, stop watching them. How is this complicated? I don't add value to your life. Why are you here? It just makes no sense. You think that it makes you look good. Everybody else looks at that and goes, well, what kind of person does that? Why don't you just leave? So I don't know. You can send me 10 more emails if you like. I'll answer them all as I always do. I'm always polite. I answer everything you ask. Let's keep going. Oh, you asked another question. Okay. Angus Chan, it seems that the AI rally will go on for quite a while. I believe so. It's scary. Regarding your expertise, is there any way we can ride this rally? I have none. So I am super tech illiterate. That's one thing that you have to know about me. When I bought my Bitcoin, for example, I literally I bought somebody's course on how to do this, right? They said, step 1, I bought a Tracer Model T little cold storage unit. And he said, step 1, buy this, go here, get your 2 keys. This is the one that's the really important one, and save this one off. I did all that stuff. I'm pretty tech illiterate. So as far as the AI stuff, I have to say, admittedly, I am way behind on that. I'm not your guy if you want to get an edge in the AI. I barely use it, right? I should use it. I think the Chat GPT could probably help out with certain things. And I'm just more scared about the AI revolution, I think, than I'm excited about it. I'm more worried than I am excited. There are some applications I think, oh, that could be useful, but I just think like actual general AI, wow. What if it just doesn't like us? Then what? And there, you know, as a whole, as an individual, I always say individuals are wonderful, but there are groups of individuals that are pretty easy to hate. So what happens if the AI just doesn't like us? What happens if the AI just feels like perhaps we'd all be better off without these annoying little viruses running around? I don't know. I'm not your guy. I built a trading system very similar to yours, and it helped me get my first data analyst job. Awesome. Thanks for the inspiration. Comment or question? Is there more coming? No. Well, I appreciate it. I'm glad I could help a little bit. I would imagine, because I can't share everything, so a lot of that is going to be the heavy lifting on your end. You probably just tweaked a little bit what I'm doing, and a lot of that credit, of course, goes to you. So congratulations there. Data analyst job, cool. I would say, just a little side note though, don't ever forget to, even if you're working for somebody else, even if you're like, this is a path that you've decided to go down, I would say always keep a mind for working on your own stuff and building your own future that you're eventually going to branch off. So nothing wrong at all with working for other people, of course. Build up skills, get the paycheck. It's hard to make money in this world. But I would also say that if you're this good, then I would say maybe you should, a little bit of on the side, try to forge your own path as well. Don't forget that aspect of it. All right, how to take advantage of the volatility barometer in relationship to things like SOXX or SCHG. Inherited some shares and want to use them efficiently. Well, the one thing that I always say, I've alluded to sort of the 60 to 70% range for most volatility metrics. I even shot a little video last week, I released it, saying if you just knew one thing about the market, and only one thing, that you want to be allocated to aggressive positions 65% of the time, and you want to be in safety 35% of the time, if you just know that, you're going to be able to beat the S&P 500. You're going to beat 90% of asset managers, and you're going to be fine. So I would say that that is the right range that you're looking for. You get the barometer signals, and I would say that you could go ahead and use that. So the only issue there is there's more to it than that. Sometimes when I say things like just a drive-by recommendation, that's not a recommendation, but a statement that I make, it could possibly do more harm than good. So what I would say is email me, and maybe we can unpack it a little bit further for you. That is pretty general. But yeah, the general concept applies, that there's nothing wrong with holding aggressive correlated to the S&P equities and, securities of any kind. A lot of securities are correlated, even though they sound different. But you absolutely have to cycle to safety. Like you said, you want to protect your assets. So yeah. How long have we been going? We should probably cut it and just start next week. All right, there's more. And how many more? 10 more questions. I think maybe we should cut it. Okay. Yeah, I see there's like 4 questions from you, so I'm trying to see if it's all connected. Okay. What are the key metrics you prioritize in the volatility dashboard? Any chance we can see the metrics from February 2020, just before the major crash? Okay, I know. Okay. You already emailed me that. I already sent you the emails. You already saw those emails. I told you that I was going to do, because that would be a really cool subject for publicly, right? To show people how the metrics were building over that time period and why we were able to cycle out so early. Mental note, I will get to that. That is an interesting question. I'll put that into a future live stream for sure. Steering clear of VTS, how's your experience with Mac been? Switch from Windows myself. I have no issues with Mac. Obviously they're too expensive. So, and the one thing that bothers me, and I seem to have to say this on every live stream because people think that their questions are being blocked, and this is a Mac only problem, that the software that I use for my live streams is called Ecamm, and it's pretty much the only one that works for a tech dummy like me on a Mac, right? It's a Mac only platform. And for some reason, the comment section over here in my Ecamm software doesn't show all the questions. It shows maybe 70% of them, right? But there's a lot of questions missing. And so I don't really know what's happening there. I've got a few ideas, though, if people are curious. So the one thing is, this is just a general thing, but if you feel like your question is not being shown to me, it was explained to me what might be happening. So this is new information just this last week. What I've done is, again, I'm tech illiterate, so what I did is I saw a YouTube video from somebody that said that you can actually be punished on YouTube, either have your engagement throttled or actually get strikes against you for things that are said in the comment section. So what I did is, this guy that made the video recommended that you input a whole bunch of words that if these words are used in comments, it'll automatically not show that. It'll just delete that comment. So I think it's possible that's what's happening, is that because I've got a checklist of words that YouTube is supposed to flag, maybe it's just not showing them. I don't know. That's just something that I'm thinking about, but yeah, who knows? Why was I even talking about that? Oh, yeah, my Mac. That's my only downside. Well, it's too expensive, but I love Mac. I'm an Apple fanboy. Everything I own is Apple. Apple Watch, Apple headphones, Apple everything. Everything that Apple makes, I'll buy it. Don't know why. Have you ever considered Iron Condors on VXX and SVXY? It would work fine, but we just don't have a reason to do that. We use Iron Condors on equities. We use short volatility strategies on those instruments. Tactical volatility uses SVXY. Wheel of Fun uses VXX. Volatility Trend uses UVXY. I have a specific purpose for all the strategies, and I typically don't like to mix them up. So Iron Condors, because I trade everything in the same account, so I don't like to do, I try to keep my VIX options for VIX. I try to keep tactical volatility. It has SVXY and VIXM. I have aggressive vol uses the VIXY, for example, SVIX and VIXY. All the strategies try to target different ETFs whenever possible. So if I start doing Iron Condors on VXX, some of those might overlap with the other strategies that I'm already using on VXX. It's just a logistics thing for me. I live in, oh wait, no, I'll circle back. I shouldn't do that. I live in Canada. How safe is my money if it's put in interactive brokers? Like, how safe are my stocks if IB fails? And how safe is my cash if IB fails? It depends how much you have. So I believe in Canada, don't quote me on this, but I believe you're insured up to $250,000. So there's that. So one thing that you can do is you can consistently, every time your account reaches $250,000, you could open a secondary one. You could take advantage of multiple different types of accounts. So there's RRSPs. There's, each one is going to have its own insurance. You can trade sometimes in those education funds if you have kids. You can share with your spouse. There are things you can do if you have a lot of capital, but you should be insured up to a reasonable level. I don't know why you think IB is going to fail. Is there something you know that I don't? Somebody mentioned this actually, like, when am I going to start opening multiple accounts? My answer to him was, I guess I should, right? Because the insurance is $250,000. But do you know something I don't about interactive brokers? I don't know. How do you protect yourself? Yeah. If you're legitimately worried about it, spread your money out multiple brokers, multiple different accounts, and make sure they're each insured. Maybe you can assign us some side hustles like Wheel of Fun we can pay attention to regularly and learn something in the process. Of course, this should not become too much of a burden for you. It shouldn't, but the Wheel of Fun is going to be a full course taught in the VTS Options Academy. So I don't want to tease too much of it here. Don't waste your time with haters. I still do. As you guys know, I still answer all the haters and I don't block them. But I get a lot of pushback from that. Like, occasionally I have to kind of spank somebody a little bit, and people sometimes look at me and like, why do you even entertain these guys? Well, I've always wanted to be that person that, like, there's really no hate surrounding me. If you follow me on Twitter, I'm never in any of these, back and forth. I don't have to monitor my comment section. I would love it if I could come to a live stream and just have a beautiful interactive community. I don't deserve any haters. I'm ethical. Everything I do is above board, but they still come around. Like this guy, for example, I have apologized, not really apologized, but I've explained many, many different times what happened. This guy, unfortunately, I'll share it with everybody else, unfortunately, investing is investing, and there is ups and downs. If you are a subscriber that joined right here, you probably think I'm a genius. If you're a subscriber that joined right here, you probably think I'm a moron, right? I mean, this is a 6-year-old could understand this, but apparently this guy is 4 years old. He doesn't understand. But I flat out apologized for the lack of performance in 2022, and we've made it all back, and smooth sailing again. Live trading for 12 years, and one of those years was down. Okay, I'm no more happy about it than anybody else is. So that's essentially what happened, is that if you join anything, if you buy any stock, if you look at Apple stock in any 6-month period, you could buy Apple stock or NVIDIA. You could buy NVIDIA stock and lose a fortune. That is possible. On something that went up that much, you can still find a 6-month window that you would have lost money. Now imagine every day people are buying NVIDIA. Most of those people are happy. There are a few people that happen to coincide with that down period. They bought it here, they didn't like the performance, they quit here, and then they become a hater for the rest of their life, and they follow you around. What am I supposed to do other than recover the losses and keep going, which is exactly what we did. Like, what more do you want? I don't understand. But like I said, I'm pretty sure a 6-year-old could understand this, and yet this guy is just repeatedly asking these mind-numbingly stupid questions. But I still entertain these people because, again, I want to be that guy that is as transparent as could be. I do my best, but I know a lot of people hate when I engage with them. They do think, like, I could go to his name right now. Where's that question? I can click his name, and in one button, I can block him from the channel forever. But I don't do that to people. So yeah, don't waste your time on haters. Probably shouldn't, but God, it just, when you're one of the good guys, there's just something about it. You feel like you want to set the person straight, because all he would have really had to do was listen to my genuine sympathy on the unfortunate timing of a drawdown in 2022. And trust that I'm an honest and ethical person and rejoin, and he'd be fully whole right now. My only job is to maximize the performance of the portfolio, and when things go wrong, which they will, this is trading, when they do the best I can to recover from it and keep going so that it doesn't derail the forward progress, which I believe, if I'm being totally objective, is exactly what we've done. So, my friend, all you had to do was just listen to all of those email exchanges that we had. You just had to open your ears. That's all you had to do. So, this is no longer on me. That's all I will say. Do you prefer low or high VIX environments? That's an interesting question. Depends on the strategy. So, for like Iron Condors, for example, they're always going to do better in higher volatility. For trend following short volatility, that's aggressively on the low side. So all of your short vol profit is probably going to happen over here during calm markets. For the Wheel of Fun, for example, where we're selling those VXX put options, it can work in all types of different environments. For my volatility step strategy, I know you don't know these names, but in my head I have these names. That strategy does fine in high volatility. So it really depends on what you're doing. That's why I have 5 or 6 that I trade at the same time, because there's no one strategy that can tackle every single market environment. Everything will have a fail point. And so the best thing to do is make sure it, on its own, has risk management. And then as a portfolio, all of them together work at different correlations. That's the best layering you can do. The last thing in the world you want to do is, like I was hammering early on, buy and hold on assets that all have a single digit return and just get your popcorn and watch them. I mean, that's just ridiculous, right? That is wishful thinking to think that's ever going to produce any money, but people en masse still do it. Not their fault. Asset managers are slick talkers, and they can get people to do things that, you know, like I said, with a 15-minute presentation on the math, back out fees and inflation, those financial advisors are never, ever going to sit their client down and say, okay, remember that marketing material that I showed you that you can expect a 7% return? There's one caveat to that. I want to lay this out for you and see if you're still in. You're going to pay 1 to 2% of your assets every single year to me, no matter what the performance is. So your 7's now 5. And the government inflation number's 4, but it's probably 5. So just heads up, your 7 is 0. Cool? You still going to go in? No. If they ever did that, it's literally the kiss of death for their whole business model. So no, they're never going to share that information with people. You really do have to get into that higher threshold to the double digits. Have to. It's like I said, you know, the difference between, make the math easy, 6% to 12%. A lot of people think that, oh, that's a double, right? You should have twice as much money towards the end. But 6% minus 1% fees minus 4% inflation, you're done. 12% minus the same fees minus the same inflation, you still have alpha. So that's why that person can retire a millionaire, and the other person that was only 5% away is going to be broke, right? It really scales badly when you have to back out at least 5 or 6% of that return. It's just, so if I did anything right today, hopefully I convinced at least one person to call Monday morning and fire their financial advisor. If, one caveat, if, because I don't want the entire industry to hate me, if you see this garbage. If there's any type of even remote hint that this is how to invest, you run the other direction. Again, like I said, I'm excluding all the people that are actually trying their best to come up with real alpha strategies. I will exclude them from my hate, but everybody else gets it. Everybody else, you know who you are and you know what you're doing. Stop that. Stop taking advantage of people. Okay. I think we're almost done. I believe you missed my second question on the VXX Condor. Any vol levels you'd recommend to flip between calendars and condors on VXX or SVXY? I would say the same thing in the course. 33% is a decent number. It's not like some holy grail, like 30 to 35 is going to be life-changing, but 33. Anything 33% or below in volatility, shift over to the calendars, because the way that we trade them, we don't hold them to expiration. So they do trade as if they are a little bit Vega positive. And the Iron Condors, of course, will always be Vega negative. So 33% vol and above. 33% to 100, short Iron Condors. 33% to 0 on the low side, long calendars. And risk reward profile is basically the same. It's just a different Vega exposure. And then, of course, that begs the question, what volatility metrics do you actually use? In the course, there is a full video going over 3 choices. So the first one, the best one, volatility barometer. You would actually have access to our community, and you would be looking at this level. So we are at 38.6%, Iron Condor, right? The other thing you could do if you really wanted to, and it is in that course, is you could use the VIX index. Here's the Iron Condor course. You could use the VIX index and just use percentiles of the VIX. So I think the number basically works out to 15.19 if you're using the VIX. What is high volatility? I think it's 15.19. Let's see if I can nail that. In a preview. Are you looking at me or? So here's the barometer. Where's the VIX? Here you go. So 15.19, nailed it. How's that memory? So anything below that, you could use calendars. Anything above 15.19, you could use Iron Condors. And the third thing I mentioned is the IV percentile rank in your trading software. So again, you could 33, 66, and you could split it up that way. So hopefully you know how to get your IV rank for each individual thing that you're trading. If you're using the SPY, you check the SPY. If you're using volatility, you would check maybe, the VIX or the VXX would have it. and that's how you would rank that. But of course, the best is always going to be the volatility barometer. All right, that's it. I made it to the end. So I understand that some of these questions were not answered. So what you need to do now is you need to go to my YouTube channel and click this community right there and ask your question in this post, the very first post. Ask your question here. There's 14 questions already. And what I'm going to do with this is I'm going to answer them on video, but ahead of time. So then as I'm posting this as an individual video, I can timestamp them so that when you watch my Q&A videos in the future, you can just look at the timestamps and read the questions. If something stands out, like I really don't care when he talks about Bitcoin, for example, just skip that one. So I'm just experimenting with a different style. I understand that probably about 30% of the questions weren't answered today, but I'm sorry I can't see them on my end. So if I just week after week are skipping your questions, I'm always going to leave that Q&A section open on the website or on the YouTube channel, and I'll definitely get to it there. For those ones, unless YouTube is shadow banning certain people, that's another thing people think, that somehow I'm blocking comments. No. Here's what's actually happening, and this is funny. This is why a lot of these haters who try to act tough and front like they're really gonna put you in a gotcha moment, they don't understand they're clowning themselves. So whenever you hear people say, my comments are being blocked, now it's possible that they are. Like maybe the person that you're following on YouTube, he really is blocking your comments. But I swear I'm not blocking comments. What's actually happening, and it's kind of funny, is that YouTube tracks your activity. And of course, YouTube is a business that makes money on ad revenue, and they don't want people making completely asinine comments on 10 different people's channels, right? So of course the algorithm is tracking people, and your comments are blocking themselves before I even see them. That's what's happening. So when people say, my comments are being blocked, what are you doing? I know that's an adversarial person already. I know that that person has done something on other people's YouTube channels that got them banned from asking questions. That's what's happening. So they can see their question when they type it in the comment section, and they think they're going to get this person, and then it doesn't show up on the feed. Well, of course. YouTube's a business. They don't want your dumbass questions all over YouTube, and they don't need that. So that's what's happening, is that you've actually blocked yourself by developing an algorithmic reputation of just being an idiot. So yeah, that's what's happened there. I do not block comments. I really, really don't. People don't believe me. Well, I've only had one or two people that accuse me of that, but I do not block comments. I highlight them on live streams with a public audience, and I answer them. If you're being blocked, you did it to yourself, my friend. All right. Yeah, I'm going to skip that one. Okay, I have to answer it because I looked at it, I highlighted it, I have to answer it. Would you consider selling VXX puts again? I sell VXX puts literally almost every week for over 10 years. This is just something, just because you don't see it on the email. Remember, the VTS email is, it's meant for ETF strategies. It's meant for a portfolio of a community that follows, that likes a little bit more structure and simplicity, and mostly ETFs. So I have not bombarded this portfolio with option strategies. Of course, the VIX options, there is no shot that people would be receiving it very well. That's going to be separate. But same thing. I sell VXX puts all the time, of course. And I'm not going to say you should too, but you've seen how I do it, right? You've seen some of my methods of doing that, and it's basically an overlay. I'm not using any margin when I do it. And if you can use an overlay strategy that uses no margin, and it's mathematically inversely correlated to the rest of your portfolio, then you can't get into any trouble. And if you could use that overlay to make even, let's say you did a 10% rate of return with a 20% overlay that doesn't use any additional margin, you just increased your overall portfolio performance by 2% per year. And like I showed before, 2% per year can make a really big difference when compounded over, that might get somebody almost to that threshold, right? Where you're getting some real alpha when you back out inflation and fees and all that stuff. So yeah, I do it constantly. You should too. All right. Thanks, everybody. Pretty good live stream today. I'm going to catch some heat in my emails, but it was a lot of fun. See you next week.